Well, last week brought another round of record highs on Wall Street, even as the US government shut down, leaving both market participants and policymakers in a little bit of a data void for the time being. Having said that, markets remain pretty much all in on the idea of a Fed rate cut at the end of the month, and one in December as well, which has seen treasuries rally, led by the front end of the curve. Despite that US government shutdown, the new trading week has started in relatively exciting and spicy fashion, with a surprise LDP election result in Japan over the weekend, and the French Prime Minister throwing in the towel and resigning as the trading week got underway on Monday. Although it must be said that the docket for the week ahead is not exactly a busy one, as participants are set to focus on ongoing political shenanigans, not only in Washington, D.C., but around the globe. In any case, plenty for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So some may argue it was a little bit of a dull week for financial markets last week in that little data vacuum that we endured, but certainly hasn't been a dull start to this week. And it certainly wasn't dull at the Emirates Stadium on Saturday either, was it, Ryan Littlestone from Forex Flow Live and Forex Analytics? The mighty Arsenal winning out 2-0 against the dismal West Ham, and that former West Ham legend Declan Rice showing us exactly where his loyalties lie.
Oh, yes, the lucky Arsenal scraping a 2-0 win against a team nearly bottom of the table. I mean, come on, mate, you can do better than that. And less said the better. Move on.
Top of the league, mate. Can't complain. You know, we can barely see you lot down there in 19th.
Well, let's see if you can finish second in the 3-horse race this time around.
Well, in that 3-horse race, there's one donkey, and I know who it is, and it ain't Liverpool or Man City. So, as you say, we best leave that one there. Let's crack on, because we've got plenty to talk about, and sadly, a lot of it revolves around politics. So let's get our teeth into it. Right, I'm going to leave the French and Japanese shenanigans to Ryan. He bravely volunteered to do that earlier on today, or should I say, he was volunteered to do that. Instead, I've drawn the other short straw because I need to talk about the government shutdown in the United States. Slightly choppy conditions last week, as I said, relatively little for participants to get their teeth into. And of course, this comes amid a lack of official US data releases after the US government shut down very much as expected last Wednesday, given that impasse or deadlock on Capitol Hill. I think it's important to stress here that from a market perspective, I know it's taking up a lot of column inches. I know we're leading the show on it today. There's a lot of hullabaloo around the idea that the government is shut down. But I would argue that this really is not as big of a deal as everyone seems to be making out to be. And I think there's probably three reasons for that. The first is that, yes, there will be a sort of mechanical hit to economic growth when the government is shut down, likely about a 10th of 1% per week for every week things are closed, if you look back at how these things have evolved previously. But all of that is then going to be recouped again in the very next quarter. And in any case, the US economy is growing, as near as makes no difference, 4% annualized quarter on quarter in Q2, and is expected to have grown at that pace in Q3 as well. So we're hardly talking about any sort of economic disaster. The second thing is that, yes, we will have delays to economic data, like we did to Friday's labour market report, although I must be honest, I'm not complaining about that because it was quite a nice Friday without being on tenterhooks, waiting for the jobs numbers and waiting to see how Ryan had fiddled me out of his sweepstake winnings yet again. But in any case, the data that has been delayed, it will be released at some point when things reopen. And we do have plenty of private sector data. You think about the ADP payrolls or the ISM surveys, for example. But perhaps the most important thing is that the government is going to get funded again. Whether this takes days, weeks, or months to resolve, there have been 20 government shutdowns in the past. All 20 of those have seen a deal struck to resume funding and to reopen the government. And this time is not going to be any different. We're not going to be sat here in 5 years' time saying, oh, do you remember when the US government shut down on the 1st of October 2025 and we're now in day 1,400 or whatever it is? That simply is not going to happen. And I think given all of that, anyone who is trading solely on the back of the fact that the government has shut down and is sort of ripping up their base case as a result of this, give your head a bit of a wobble, please. It's a bit of a storm in a teacup, to be completely honest with you. And certainly from the Fed policy perspective, I don't think this is going to impact the FOMC at all. And I think certainly the market's mind and my mind is still very much in the view that they deliver a 25 basis point cut later this month and another one in December.
If there's one thing I like trading against, it's people's complacency.
Here we go.
I'm gonna caveat that by saying yes. Is anyone going to pile into selling US assets based on the shutdown now? No, absolutely not. The issue I've got though is it is on the clock. We could be sitting here in 2 weeks' time, 3 weeks' time, with the government still shut down, no data coming, the market getting antsy over what's going on with the economy. And if there's one thing we know about markets, they get bearish far more quickly than they do get bullish over unknowns like this. So, yeah, we may not be seeing much of a reaction. And if it gets solved this week or next week, then, yeah, everyone will blink and that'll be it. We'll move past it. But if it does drag on, it's going to have an impact in markets. How much? I don't know, but it's going to be negative. And as traders, which a lot of us are, we've got to look at those risks and think, okay, how are we going to trade if this does drag along? And if we don't get data, is it going to impact the Fed? Because we've got some Fed members saying, oh, it doesn't matter, we've got other data to look at. And then we've got others saying, well, we're going to be short that data going into the meeting. So it's not necessarily going to have no impact on the Fed, on the next Fed meeting, depending on how long it goes on and how much data they are missing out on. So, yeah, you can be complacent in terms of how it might trade now, but don't be complacent if it drags on.
Well, I would offer you a lunch bet. We've already got one going, so we can't have two running concurrently. But thanks for that. Thanks for that dose of cheeriness anyway, mate. Why don't you continue on that optimistic note? Because it's not just a political shambles in Washington, D.C. It's happening everywhere else. In fact, is the UK a bastion of political stability at this moment in time?
I don't know.
I assure you, I have not been drinking this lunchtime.
I was going to say another lunch. I mean, you had an early one on Friday.
This is water. Don't worry.
Oh yeah, another gin. That's a bit like the Guard press conferences. A pint of gin on the table. No, I think if you're thinking about the UK in politics, then it's probably standing on the head of France while that's underwater. So yeah, they're all in the same swamp, shall we say? Right. Anyway, yes, two big shocks for markets as we come into the week. Firstly, Japan's Tsunade Kiichi won the PM election, causing a massive gap higher in yen pairs. Now, polling going into the election was in favour of the second, who turned out to be the second place, Koizumi. He was ahead with LDP members. So this really caught the market on the hop this weekend. Now, as we're recording this, dollar yen has been up to a high of 150.48, and well, I was going to say it did remain pretty big, but I'm looking at it now; it's trading back down to 149.80. I think we're going to see the yen remaining a bit weak for the foreseeable session, shall we say, until we get the full slate of her pledges, political pledges for the economy, and what she's going to suggest about the Bank of Japan. Now, she is a fiscal dove and didn't appreciate the prior hikes from the BOJ. She's also said that she may have to look at that accord, but 20 minutes, half an hour ago, she did come out with some less than inflammatory comments on the Bank of Japan. Now, one plus point there has been is that she said she's going to keep the trade deal that Shiba made with Trump in place. She's not looking to renegotiate that. So that's one market risk removed potentially from that. So I think you have to be careful trading the yen over the next few days and be ready potentially for some verbal intervention if we see these huge moves continue, if we're rocketing up another 200 and 300 pips a session. For now, looking at the chart, 150, 80, 90 is a bit of a key level. We had a prior high up there. It's been a level going back some time as well. So if you are looking at the charts, it's these sort of big levels you need to focus on. It's no point looking at your sort of 15-minute charts at the moment. We have broken 150, which was the late September highs now. We were finding support into that early on today, but we've broken that today. So maybe we're going to see a bit of reversal going in. Right, after that, moving on to the second shock.
I was just going to say, can I come in there on Japan before we move on to France? Because that's equally as shambolic. I think you summarised that very, very well. I think the interesting thing for me is how, even between sort of Saturday morning and Monday afternoon, we've seen an apparent pivot in the rhetoric from, Saturday. Some of the remarks from Takaichi were quite punchy around, I am not wanting to see. Basically, I don't want to see the BOJ do anything else. I'm the king now. You either please listen to what I'm saying and slam the brakes on policy tightening. And then the remarks we had probably about an hour ago from one of our main advisors, Honda, a lot more caveated, a lot more arguably what I would say sort of market friendly. And also it was interesting that he sort of put 150 out there as a line in the sand in dollar yen, saying a move above that is concerning. So it is clear that they are watching. They are aware of what's going on. And I think, as you alluded to, as a result of this pretty adverse market reaction, not just in the yen, but the steepening of the JGB curve as well. I think you might see them dial down the punchy rhetoric a little bit in the coming sessions, at least.
Yeah, and it's something we've seen a lot with politicians. They're all mouthy before they get in the hot seat, and it's a different kettle of fish when they are in the hot seat. And they will be watching markets and seeing the reaction. They won't mind the Nikkei moon shooting, but the yen weakening as much as it has will be a bit of a problem for them. But anyway, moving on to France, as you say, that other basket case, that was a second shock of the week with the new PM Le Cornu resigning after 27 days in the job.
He managed half a Liz Truss.
Yeah, but I think it was even less than that, because I don't think Macron put him into his cabinet until over the weekend. So officially he was only in a job a few hours. But anyway, he picked up a bit of a poison chalice in the first instance. But I don't think many thought his tenure was going to be this short. Now that gave the euro a bit of a dig in the ribs this morning on the surprise, and it does pile a lot of pressure on Macron to maybe call another election. And it was his election in 2024 that blew up in his face and has caused all this since. Now, if he does call an election, and from that we get a clear winner, whoever it may be, that can form a government and actually pass a budget, that might actually turn things around for France and get them out this political stalemate at least. And that could see the euro actually recovering on the back of that. But that's a lot of ifs, buts and maybes. So until we get some clarity on all this, France remains, as noted, a bit of a basket case. And that could keep the pressure on euro dollar, at least in the very short term. Now, traders of that pair have just been reminded that this hasn't rallied all year just because everything is going so well in the Eurozone. So for euro dollar now, we're still firmly in that year's uptrend. I think from here, we're probably going to see further sideways action as we navigate between the politics in both the Eurozone and the US. So I think range trading from here is probably the best strategy.
Yeah, I think you're probably right on that one. I must admit, I am slightly annoyed with the French Prime Minister, because I'd written in a note this morning about 8:20. Le Cornu, his days seemed to be numbered, ran off to take a phone call. By the time I got back to my desk, he quit. So that's how unexpected that proved to be. I think the big issue for France is, you look at political instability. For example, in Japan, we were talking about that. Let's use that as a parallel. There's political instability. The LDP have lost their majority in the upper house. What's the solution? It's a new party leader, and they go down that path. I think the problem for France is you kind of sit there and you go, what's the solution? I don't think there is an easy solution, because Macron can try and appoint a new prime minister, which would be 6 in about 2 years, but they're going to face exactly the same parliamentary arithmetic that has got rid of the last 5, and also exactly the same issues in trying to pass a budget and actually reduce the deficit and get things on a much, much steadier footing. You could go down the route of assembly or legislative elections, but you look at the opinion polls, and to be honest, that's probably going to produce a more divided parliament than it is now. So you're then back to square one all over again, just with slightly different arithmetic to try and work out. You could even get to the situation where Macron steps down as president. You have a presidential election, but again, is that really going to solve things? Because you've still got that issue in the National Assembly. So I think the problem for France is market participants sort of looking at the situation this morning going, okay, fine, another prime minister's gone. This is basically a monthly occurrence now. We're not overly worried about that. The problem is there's no sort of silver bullet that you can just go, right, that's the solution, and they're going to reach out and grab it. You're kind of sat there going, well, we don't know what's coming next. And I don't know whether that's going to be as much of an issue for the euro. I think it will be a modest headwind at least, but certainly for something like OATs, French government debt, that's a big, big negative because you've got fiscal risk to price in. You've also got this just huge uncertainty about how the next 6 weeks are going to evolve. And the last thing I'll say is it's 2:20 on Monday, London time, as we film this. We haven't heard from President Macron. We have no idea what the guy is planning to do next. And I think, again, that void is not helping anyone.
No, I like to call him Mr. Busybody because if there's a geopolitical situation going on, he's usually got his oar in somewhere, be it in Russia, Ukraine, Israel, whatever. He's always front and centre of the pages, trying to keep himself valid. And like you say, he hasn't actually popped up in his own country except to accept the resignation this morning. So, yeah, but this is something that's not unique to France. There are other countries, Eurozone countries, European countries that have not got strong governments. Look at what's happening here in the UK. You know, we had two main parties, and it looks like most people won't want to vote for either of them. So we could be in the same situation in a few years if something doesn't happen sooner. So, yeah, but back to the France situation, you're absolutely right. If it drags on, they can't pass a budget. EU is looking at them, waiting to tick it off, and then you're going to get the rating agencies, like you say, maybe downgrading them, and it just becomes a bit of a spiral.
Yeah, absolutely. I did joke, obviously, about the UK being a bastion of political stability. In the Eurozone, you know, it's ropey when Italy is the most politically stable of the major economies. But anyway, before I annoy any of our Italian viewers, we best move on to earnings season, because that is getting underway in relatively short order. Next Tuesday, JP Morgan, Citi and some of the other big banks on Wall Street start to kick things off. And reporting season is, of course, always important and interesting for market participants, but maybe takes on a little bit of extra importance this time around, given the government shutdown that we mentioned earlier. We've got a bit of a lack of economic data, so these earnings releases taking on a little bit more importance, not only in terms of the health of the companies in question, but also whether they can act as a sort of bellwether or give us any read across to the broader US economy. Anyway, in terms of expectations, earnings growth for the S&P 500, that's expected at about 8% year on year. That would mark the 9th consecutive quarter of annual earnings growth, which is a very, very solid clip indeed. Revenue growth, meanwhile, that's expected just over 6% year on year, which will be the 20th consecutive quarter of annual revenue growth. I think that takes us all the way back to the pandemic, if I've done my maths correctly, which feels like about a century ago at this point. It would also be the second fastest pace of revenue growth since 2022. Now, in terms of some of the sector-specific names, obviously mentioned the banks earlier. The other area that's going to be in focus, obviously, certainly from a sort of narrative perspective, is going to be the Magnificent Seven. All of those 7 stocks now trade positive year to date after Apple flipped into positive territory towards the middle of last month. And that group is set to report earnings growth of about 12% on a year-on-year basis. Now, as I said, you've obviously got the sort of bellwether effect as to what these firms can tell us about the broader economy. But I think also the upcoming reporting season is going to be a big test for the market at large. If you think about the bull case that we've been harping on about, or at least I've been harping on about for the last 6 months or so, it's all built on the idea that earnings growth is solid, economic growth is solid, and then that third leg originally was a much calmer tone on trade, and now it's the idea of a much looser monetary policy backdrop that we've really been trading on the back of since Powell performed that pivot at the Jackson Hole Symposium towards the back end of August. Now, I don't see, this could be famous last words, Kyriakos, get ready to clip this one up. I think we should be in for a pretty solid earnings season. The economy has remained resilient throughout the last 3 or 4 months. Consumer spending certainly has remained very, very healthy indeed. Uncertainty on the policy front has continued to fade. And of course, the other thing to bear in mind is this whole AI frenzy is still going on, and there are signs that firms are able to monetize that capital expenditure as well. If we do get that solid earnings season, then I think that's really going to cement that bull case and cement that path of least resistance higher into year end. And again, sadly, we can't have 2 bets running at the same time. But if we could, I would ask you, Ryan, do you think the S&P will trade to 7,000 by year end?
Yeah, I think it's got every chance, and you're probably in the same way. So
absolutely.
We need to have a bet. We need to find a bear to have a bet against, and then
there aren't any left. That's the problem.
We're in hibernation. So yeah, I mean, yeah, I agree with you. I don't see any reason why we should get any horror stories from that, unless some of the banks, and if their Q4, if the start of Q4 is any way to go by, they're trading in dollar yen, it's going to cause them some angst because is it Goldies who was short in the
And Deutsche,
147?
I think, have bailed out on that one.
I think there was a couple of them though. There was Deutsche and I think Goldman's who was short going into this weekend, and they've been forced to get out of that. So yeah, hopefully their FX has trading's been better in Q3. But yeah, I think the other thing we should do is should probably start a market. How many times any of these earnings are going to mention the shutdown as to what might happen in Q4? Because it's coming. Oh yes, we had a good Q3, but Q4, oh well, it's a shutdown, so we don't know what results are going to be like. Then they're going to get the excuses out, in spades for that. So yeah, I think we'll make a market on that somewhere.
That is a good shout, actually. And I think that sort of speaks to another point I was going to make, which is that the risk around earnings season is basically that markets have set the bar too high. Are those firms able to live up to those expectations, I guess, is the big risk, particularly when you look at some of the AI plays like Nvidia, but they don't report for 6 or 7 weeks now, so we don't need to worry about them. What we do need to worry about, because I think this will probably drop in the middle of earnings season, is the identity of the next Fed chair.
Yeah, well, that's what we're waiting for. This week sees week 2 of all the interviews that Besant's doing for new Fed chair.
Have you had your phone call yet?
No, not yet. I only wanted to cut rates by 150 basis points. I probably don't pass the bar for that one. But what's really been strange, I think, is that they've managed to keep a fairly tight lid over who's been interviewed. We know the likely suspects are in the frame, but it's probably more we need to focus on finding out about those we don't know about, because that's, I think, where we might get the real market shock from. In US betting markets, Waller is apparently leading ahead of the 2 Kevins, followed by Miran, Bullard, Reed, and our favourite Zervos, who I'd love him to win. So that there's seemingly so many being interviewed maybe suggests the administration isn't sure about any of those front runners, although they're saying there may be a pretty low bar for gaining an interview if you're happy to put that you'll cut rates by 200 basis points on top of your CV. I'd say it's likely that those interviewed last week and this week will then, probably get whittled down further interviews over the coming days and weeks. But we should perhaps get prepared for if Trump or even Besant decides to drop a bit of a shortlist on us after this round of interviews. When we do find out who exactly will be Fed chair, it could actually change the whole dynamic for the market and its rate cut expectations, even while Powell is still in charge. So until then, I'm prepping my new Zervos tattoo in the hope he gets a nod.
I would love Zervos to become Fed chair. I think they would be the most entertaining press conferences you could possibly imagine. Also, we would just talk about whether the S&P will trade 7,000 by year end. If he gets announced as Fed chair, I think it trades 7,000 by the end of that day, given how bullish that would be for risk. But yeah, you're absolutely right. I think it is an interesting one. I mean, it's all gone weirdly quiet, because obviously we had that sort of 11-man shortlist. And again, they were sort of weirdly public about that. And at the time, I think we were speaking about whether that was an attempt to sort of encourage all of these people to basically sound as dovish as they possibly can in public and pile a bit of pressure on the current FOMC in order for them to embark on a dovish pivot. But since those 11 names were made public, we really haven't heard a lot on this front as to what's happening next. If you look at when Powell became chair, I think that nomination was formally made at the start of November of 2017, it would have been. So we are sort of getting towards, if not within that window of when we should get some news on this front. But yeah, obviously we sort of stand by our terminals and await that one. But I agree with what you were saying. And actually, I put a note out. It's on the bit of self-publicity. It's on the Pepperstone website if anyone wants to have a read of it this morning, effectively arguing that I think Powell is already sort of yesterday's man. And let me clarify, I think he's done a damn good job in the last 7.5 years at the FOMC, certainly given everything he's had to deal with. But there are only 5 meetings left for Powell to chair as Fed chair before his term in that job expires. We know the conclusion effectively of 2 of those. It's going to be a 25 basis point cut in October, probably going to be one of those in December as well. So realistically, there's only sort of 3 quote unquote live meetings that could be left for Powell to deal with. is. And by the time that January meeting comes round, we will know who his successor as chair is going to be anyway. And actually, by the time that January meeting comes around, and certainly by the time that March meeting comes around, there's every chance that his successor might actually be sat around the meeting table and as part of the FOMC if they end up nominating that successor to fill the governor spot that Stephen Moran is currently filling, with that term expiring at the end of January. So there is every chance, really, I think, that the market is going to take its cue more from the new guy as opposed to the current guy.
Yeah, and I don't know if it's possible, but what happens if the government's doing shutdown? Can they actually pass the nomination and still get him on?
Yeah, I think so.
You can say I don't know. It's quite.
I'm trying to work this through in my head, and I think the answer is yes, because the Fed are a quasi-private institution, so they are not subject to the government shutdown. The Congress is not subject to government shutdown because obviously they're voting on deals to try and reopen the government. And as far as I'm aware, the only other people involved in that process are the president and the White House offices, and they're not shut down either. So my hunch is yes, but I don't know.
That's going to be a fun one if we're still shut down come December. I can tell you that.
I'd best go and do some revision on that. While I do, roll the titles for Play of the Day. Right then, I'm going to look at silver this week, which probably means that this week marks the top for the shiny stuff. Anyway, there has been a lot of focus on gold in recent weeks. I think we've had, 7, maybe 8 weeks of gains for spot gold now. But it's not just gold that's been having all the fun, because other precious metals have been joining in as well. Now, I've got my crayons out here, Ryan, which I'm sure you're very, very pleased to see. And even a sort of heathen like me can see that this chart is it's a thing of beauty, really, isn't it? The way that that's ripped higher over the last month or so. And frankly, the bull case for silver is really the same as it is for gold. Silver is effectively the higher beta cousin of the yellow metal. And that bull case, just to recap, is pretty solid physical demand. Certainly, if you look at ETFs, they are way off the highs in terms of holdings that we saw in 2021. So suggests a bit more room to run there. You've obviously got the risk that inflation expectations become unanchored, runaway government spending, and that's boosting gold, it's boosting silver, it's boosting platinum, etc., etc. From a technical perspective, given my crayons on the chart there, now that we're above this 47.5 level and we close north of there on Friday, towards the back end of last week, well, the obvious target is those highs in 2011, and that leaves us looking towards $50 an ounce. Now, personally, looking at this chart, I would not want to be trying to short this one. It'd be like picking up pennies in front of a steam train. I think this is one where you really want to look to ride the momentum higher. As long as we trade north of that 47.5, it's a market where dips are there to be bought. But this is certainly not one where you want to be trying to be a hero and picking a right.
Yeah, before we do that, I was going to say that chart you had up there, I think if you zoom out a bit wider, you might find it's forming a right ear of the old Batman formation.
Are you on that? Don't bring the chart back. Don't encourage him. Goodness sake. Oh,
love a good old Batman formation, man. Yeah, there we go. $1 for me, and I'm potentially getting ready for a break up through this small zone we've got going on. It's been a few weeks since I last looked at this pair. Since the break under 1850, it's been stuck between there and the 61.8 fib of the swing from 2024. Now, the price action at the moment shows the price maybe wants to trade up at that 1850 more than it wants to down at the fib. So that's getting me thinking about a break trade up through that 1850 level. For the record, I'm still core short from up near the 21s, and then I've been jobbing it short from the 1850 level as well. So I'm looking to take that trade off if we do get a dip, but I'm also looking for a potential break trade up through that 1850 because that might be the one that has legs. So I'll either try and get out my shorts at better levels now, or I'll just fold it into a stop reverse and go long if we do break that level. So looking for a break in this one.
Good stuff. We'll keep an eye on that. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully, you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know your thoughts on what we've discussed, how you're trading the markets, or if there's anything you would like us to discuss in the trade-off next week. And that is when we'll be back with another episode, seeing what on earth has happened in all of those political pantomimes. And given the way things are going, I would not be at all surprised if the UK decides to join in on that act by this time next week. In any case, thanks again for watching. Have a great week ahead, and goodbye for now.